So I think I have about 30 minutes, Chad, right? So, wait, perfect. We've got, well, we might do that a little differently. We've got about maybe 15 minutes worth of slides here to run through, and then Q&A where we can just go through any questions that you guys might have. Just a quick background on myself. My name is Arif Janmohamed. I'm a partner at Lightspeed Venture Partners. Some of you may know us, some of you may not. Lightspeed is a venture firm that's based out of Menlo Park, California. We do primarily early stage investing. We're on our 9th fund now. We manage about $2.7 billion across a number of funds. Historically, have invested in enterprise infrastructure, internet, digital media, as well as a little bit of clean tech, sort of cherry picking over there. We've been fortunate to work with some great entrepreneurs over the years, including the founders of Brocade, Riverbed, Fusion.io, more recently Living Social. I hope you guys are all getting your deals today. Shoe Dazzle, for those of you who want to get subscription shoes, I would log on and get a fantastic deal. Bonobos for the guys over here in the audience, you know, some fantastic clothes. Petflow for the pet owners, etc. You know, we like to team up with exceptionally talented, passionate entrepreneurs who want to build multi-billion-dollar companies. So if you're one of those, come and find me afterwards. I'd love to talk. What I will do here is walk through sort of the first piece of, call it company creation, as well as your pitch creation. That's the value proposition. So jumping into it, what is a value prop? Well, it's essentially it's a framework for helping create and inform someone's decision. And I'm going to talk about two types of value props. One is the customer value proposition, and then second is the investor value proposition. I would argue that the customer value proposition is infinitely more important than the investor value proposition, because this is the framework that will actually set the stage for the next 5 to 8 years of your lives. Nowadays, Instagram aside, it can take on the order of 8 to 9 years to actually create a multi-billion-dollar company. And so putting the work in early in terms of figuring out your customer value proposition is incredibly, incredibly important. Too often we come across entrepreneurs who have come up with an idea, a technology, a potential product, a widget, whatever that might be, but haven't thought through, and I will talk through them, 5 key pieces of what a value proposition is. And so before you actually jump into finding a co-founder, raising capital, building your technology, I would strongly recommend that you think through very carefully what the 5 pieces are of your customer value proposition is. What are you going to be selling, right? So what is the purpose of the product that you are building? What does it do, and why is it important? Who are you selling to? What is the audience? What is the category? How large is the market? We'll go into this a little bit more on the next slide. What is unique about what you're building? And finally, what is significant? There's a difference between uniqueness and significance, and we'll get into that on the next slide. But really, the main point over here that I'd really like to emphasize is before you write any code, before you actually jump in and found a company, raise seed capital, et cetera, think through these 5 issues. Who are you selling to? What are you building? Why is it important? And ultimately, how will this translate into an investor pitch? But the investor pitch is secondary. For you, before you jump in, make sure you understand what you're building and why it's important. So what does that mean again? Again, you know, purpose, what does the product or service do? Right? Try to articulate it in a very, very short amount of words. If it takes you a paragraph or 2 or 2 minutes, 3 minutes to really talk through what you're doing and what is important, it means that it's not clear. Try to be succinct here, because if you can be succinct, that means you can explain it to an investor, but you can also explain it to a customer. Incredibly important. Audience, who's going to buy this? Figure out who you're selling to. This is really, really important. Too often we come across entrepreneurs who have an amazing product but haven't quite figured out the product market fit. So who is your audience? Why are they going to buy this? Why are they going to be excited about this, right? And audience actually informs addressable market, which for an investor is incredibly important, but also for an entrepreneur is incredibly important. The larger the target market that you're going after, the easier it is to sort of zig and zag within that market. And by size, I'm saying try to go after billion-dollar markets as opposed to million-dollar markets, because the amount of mistakes that you can make in a billion-dollar market is actually infinitely larger than the amount of mistakes you can make in a smaller market. And also, if you tend to, let's say you create the best possible product in a small market, well, you're still left with 100% market share but a very small revenue stream. Significance, this is where I would spend a lot of time really thinking through what are the key benefits of your product. Why do people care? Why would people care? You could think through this, but a better way to actually figure out what the significance of your product is to go out and talk to customers. Go out and talk to customers. Really pitch them on your product before you've even built it. See their reaction. You'd be surprised at the sort of feedback that you can get from customers who will say, well, that's good, but I would love to see A, B, and C. Listen. Listen to your customers because they will tell you what they want to buy. And so you may have an amazing piece of technology or widget, but it just needs to be repositioned or sort of gain a couple of extra features to make it something that will actually be incredibly significant to a customer. You want this stuff to fly off the shelves. You don't want to have what in investor parlance we would say is long sales cycles. Category, this is really important. This will inform who you're competing with, and really will inform sort of what the economics will be of your product. If you're in a crappy category where the margins are typically 1 to 2, maybe 10%, well, no matter how good your product is, you will end up with around that range, unless you've got something completely disruptive. So figure out who you're going to compete with, how favorable the economics are of that category, how competitive that category is, because that will really inform, one, how much money you'll have to take, and then two, what your features, functionalities, products will have to look like so that you can effectively compete in that category. Uniqueness, well, this is somewhat tied to significance, but what else can a customer buy? What is unique about your product from a feature functionality perspective? How will you differentiate over time? Is it just technology? Is it branding? Is it user interface in the internet world? Just think through what is absolutely unique about your product and tie that through to what you're doing, who you're selling to, how big the market is that you're selling into, what's significant about your product, and what category you're competing in. So before you even put any effort into your slide deck, think through this stuff. Spend a few weeks, spend a few months talking to customers to figure out what your value proposition is. In this valley, what I love about Silicon Valley is you can go to places like this, share your ideas, and people will give you immediate feedback. People will connect you with people who may be experts in this space, who may have gone through this, through things before in your space. Talk to as many people as you can. Don't hold your cards close to your chest. Ideas are actually commodities. It's all about execution. So go out, talk to as many people as you can, share your idea, solicit feedback, and that will really feed into your value proposition. So that's your customer value prop. Now, what do we care about? Investors. Well, there are three main things that investors care about when we're evaluating companies. And I'll preface that by saying that we see a lot of companies and we do very few deals, right? We'll see on the order of thousands of opportunities every year. We will fund on the order of tens of companies every year, maybe 10 to 30 companies a year. So the bar is extremely high. You're competing with a large amount of very talented entrepreneurs. So keep this in mind, the next three things that I'm going to talk about, when you're presenting to investors, because this is how we tend to evaluate every single one of the companies that come in. One, team. Who are you? Is this team uniquely qualified to win in this market? Is this team passionate? Does this team have a unique differentiation and an unfair advantage in the market that they're going after? Two, is the market worth going after? Is it a multi-billion-dollar market? Again, I talked a little bit about this, but markets to us are incredibly important. We tend to look at very carefully, for a given product, what market you're competing in, so what are the user economics of that market, and second, what are the financial economics of that market, and third, how large is that market? Is this a market where there's a large amount of customers that really, really need a product that is like yours? Or is this a market where what you're building is nice to have and people may or may not pay for what you're building? Okay? And then third, plan. Do you have leverage in your plan? I would hate to see a business plan where you need $55 to $60 million to get to revenue. Sorry. If the more you can do with less is better. So is there leverage in the plan? And what that means is, do you scale out of proportion with people? So can you get to significant revenues and get operational leverage in your plan once you go to market, or do you need to scale with people? So there's a difference between services businesses and product businesses. Services businesses tend to need to scale linearly with the amount of employees in the business. Product businesses and network businesses tend to get network effects, and you can leverage things like channel or word of mouth or whatever that might be. And so has the entrepreneurial team thought through how to get to market very cost effectively and how to gain an unfair advantage in a very large market? Okay? So a question that I get a lot is what happens in a venture meeting? So what happens? You drive up to Sand Hill Road. You then have on the order of half an hour to 60 minutes with an investor for your first pitch. Now, one thing that I would emphasize is your goal out of the first pitch should be to get a second meeting. It should not be to ask for money immediately. Your goal should be to get the second meeting, which should then be to get the third meeting. So with that in mind, remember that you have 3 minutes. The first 3 minutes, first impressions really do matter. We see, some days we see 10 pitches, some days we see 2 pitches, but depending on on the day, we may have seen a number of other interesting companies and might have a lot going on in our minds. We make very, very quick decisions in terms of people, who you are, how accomplished you are, and are you a team that we would get very excited about working with, what is important about your product, and how you can do this better than others. So articulate in those first 3 minutes, establish credibility in terms of who you are and what you've accomplished in your lives. Why are you uniquely suited to going after a market or building a technology in a very interesting market? And what is different about you versus the other 10 startups that are going after the same market? Those first 3 minutes really do matter. And so the best pitches that I see are the ones where entrepreneurs come in, very succinctly talk about what they have accomplished and who they are, what the team looks like, and then articulate a large market and a unique product. Hard to do in 3 minutes. Even harder to do in 30 seconds, which is the elevator pitch. Okay? So first 3 minutes, you're setting the tone, and then the next, call it 57 minutes, should really be a discussion between the entrepreneurs, the team, and the investor. It shouldn't. I think the best meetings are those where it's a dialogue. There's a framework, which is a slide deck, but there's Q&A going between the investor and the entrepreneurial team to really understand the 3 tenets that I've talked about: team, market, and product. Okay? And so the next 57 minutes, you can really establish yourself well, but you can also de-establish yourselves in the next 57 minutes. So make sure that you've thought through your value proposition as well as the investor pitch in terms of the value prop that we tend to look for. The worst elevator pitches, we'll talk very quickly about what an elevator pitch is, but the worst elevator pitches are ones that ramble on. For those of you that don't know, an elevator pitch is if you were to get into an elevator with a venture capitalist, you have between the first floor and call it the 5th floor to get that person interested in taking a meeting with you. That means you generally have between 20 and 30 seconds to talk about who you are and what you're building. So you have to be extremely concise. You have to be extremely concise. The best way to get our attention is talk about you and your team, why you are special, and 2, talk about something in an extremely large market that's differentiated. But do it extremely concisely. Hard to do. So why is the value prop important? We've talked through this a lot, but from an investor perspective, the value proposition is really important for us because, 1, from your value prop, where you're talking about product, significance, category, audience, and uniqueness, that really flows into your elevator pitch. Those 5 tenets should flow into your elevator pitch in a very concise manner, right? The simpler, the better. Don't ramble on for 2 minutes, 3 minutes, 4 minutes. That's the best way to actually lose someone's attention. Okay? The value prop actually becomes the storyline for your entire pitch. The best pitches are those that are short and sweet, maybe 10 to 15 slides, no more, that talk about team, that talk about market, that talk about product, in some cases talk about technology, talk about competition. But all of that you should have thought through before you even started your company. That should all flow through and create a framework for your investor pitch and also for your business plan. And for us, your value proposition actually becomes our investment thesis. So we have partners. We actually have to justify our excitement about in working with and investing in a team. And so we have to pitch to our partnership, and this is something that you should keep in mind, we have to pitch to our partnership the value prop about the team, about the market, and about the product to our partners to sell them. So your value proposition, the tighter it is, the better thought through it is. It really helps us articulate to our partnership why this is a team that the partnership should get behind, why this is a market that we should be excited about, and why this is a product that is absolutely uniquely qualified to win in a very competitive Silicon Valley. So when you're pitching us for those 60 minutes, generally we have knowledge about your space, so you don't have to start from basic principles, but you're the expert. And so gauge body language, lean in, tell us a little bit more about your business, about your market, about your product, but you don't necessarily have to start from first principles. What is most interesting is the most passionate entrepreneurs are those who are able to get very excited about their product and market and team and talk through in a very concise and simple manner about why they're going to win, why they're going to build the next multi-billion-dollar company. And like I said before, we will use those 5 tenets: purpose, audience, category, significance, uniqueness, when we talk to our investors, our partners, and when we come up with our investment thesis. And so we will use that as a basis for wondering, is this something is this a product that actually has purpose that we should take on risk? Is this a team that we want to get behind and work with for the next 5 to 8 years? Is there enough significance? Is there enough differentiation in this product that it is something that we should put millions of dollars behind? Is this a net attractive category, i.e. is this market interesting enough from an investment perspective to actually create a multi-billion-dollar company? And what's unique about these guys? So first principles, customer value prop, flows all the way into investor prop. Okay? Getting a little repetitive, but this is all we really need to know about your business. Value proposition is really all we need to know. And so it is incredibly important that you do. The most important word on this slide is concise. The shorter, the sweeter, the better. Just be absolutely concise. We see a lot of people send us sort of the 1 or 2 or 3 page or summaries on their companies. It's not about how long it is. It's actually it's about how concise and to the point you can actually be, because we have limited time to read these things. Pictures are really, really, really valuable here. And they're a great way to illustrate what you're doing and what you accomplished, what your product does, and what your technology does. So 3 considerations. We back exceptional entrepreneurs who are passionate about their customers, who have talked to their customers, who have got feedback from their customers, and really understand what is significant about their product to their customers. We look for large, rapidly growing markets, multi-billion-dollar markets, where there is a need for your product. And finally, we like to see innovation, disruption in your product from either a technology perspective, a business model perspective, or a product perspective. So what do you need to do there? Well, we've talked about it: team, market, and you need a product to actually win. I'm not going to go through all of these. You've got them hopefully in all the decks that were circulated, but this is sort of a good framework to think through as you're building your value prop and as you're building your deck. But you don't have to have all of them, but it's good to go through them and as you build your own checklist. So a question that I also get is, what does the process look like, right? And remember I said your goal for the first meeting should be to get to the second meeting. Well, before you even do that, think carefully about whether you really need to raise institutional capital. Think about whether you're better suited to seed capital, institutional capital, or even bootstrapping. In many cases, your company may not be suited to venture capital. Remember, the business model of venture capitalists is to aim for multi-billion-dollar exits. And so that can create, in a smaller market or in a category that may be unfavorable, or in a product that may be unfavorable to large markets, it may create a little bit of tension between the investors and the entrepreneurs. And it could also create interesting side effects. So think through, we will generally look for, in a Series A investment, somewhere between 20 and 40% of your company. So if you think that it's reasonable to get to $5 million in revenue over the next 5 years, given your product and your team and the market that you're going after, well, $5 million without venture, you could perhaps sell that company for $30 to $50 million, hopefully. If you take venture, we are going to aim for a 10x 10 times our money. So let's say we put in $5 million. We will want to see at least $50 million come back to us. For 20% of that company, that you're now talking about a $250 million exit, which means you have to build a company that gets to $50 million in revenue, or 40 or 30 million in revenue. So just think through what is realistic for your product and the category and the differentiation that you have, and what you really want to do with your company. Be honest to yourselves. Bootstrapping a company, building a cash flow business sometimes, it can be a great outcome. Taking a very small amount of seed capital and turning that into a $20 to $50 million exit, that's great. You haven't taken massive dilution. But at the same time, if you want to build a multi-billion-dollar company, then come and talk to the people on Sand Hill Road. Your goal is to, one, get a warm introduction to a venture capitalist. We see a lot of things come over I guess the technical term is over the transom, but it's a cold email. Those generally get caught somewhere and may not get read. If you can find someone that a venture capitalist knows, trusts, those could be lawyers like Chad, those can be accountants, those can be other VCs, those could be other entrepreneurs in the ecosystem. Just get a warm introduction to a VC. That in itself should lead to a first meeting, 30-minute call, maybe an hour meeting, depending on the interest in what you're building. And then think through, and then you should be aware of what the process looks like. First meeting, there'll probably be a second or third meeting to really dig into what your product does, who you guys are, what's different about you, talking through competition. That can take anywhere between 3 weeks and a few months. In some cases, you may get the immediate feedback that says, look, you're a little early for us. Come back and talk to us after you've talked to more customers. Come back and talk to us after you've raised a seed round. But for an institutional Series A process, it can take anywhere between 3 weeks and 3 months, leading up to the eventual partnership meeting, which is a meeting where you come in, present to the entire partnership. The investor, who will be your board member, then has to sell that company's value to his or her partners. And then that can lead to term sheet and final docs. So there should be a period of diligence, which would include things like professional references, so set those up well ahead of time, understand what they're going to say about you. Customer references, depending on the stage of company and what you're building. So have beta customers ready to talk, or alpha customers, or even people, if your product is not yet out in the market, people who can talk to the value proposition of what you're building, why what you're building is significant and unique, and why they would pay for your product. And then there will likely be a technical diligence session if you're building a technology product, where we will go in and bring a friend of the firm who can come in and look under the covers and help us understand what is unique about your technology and differentiate about your technology. What's interesting here is raising financing is about managing a process. You're managing a number of investors, but you're also managing your references. You're also managing your value prop. You're also managing your deck. You're also managing your team, who will have many questions about where are we, have we raised money yet, have we not raised money. The thing that is probably most important as you go through the financing process is to listen. Because you will get feedback along the way in terms of, it might be you're a little early, or maybe you need some more customers, or this seems to be a very crowded market, or I'm not really getting what your value proposition is, or I'm not understanding what is different about it. Listen, iterate, continuously take that feedback and try to get better. So, to finish it off, think like an investor. Make sure you articulate your business value. Your pitch is essentially a story, but the pitch, as I've said before, should flow from a value proposition. You should come from customer value proposition and then think like an investor. Convince us that the market is massive. Convince us that you guys are an incredible team that the investor should work with. And that the product is absolutely differentiated, something that every customer needs, and that will be a category killer. We like to invest in the number 1 or number 2 company in a given category. Focus on business fundamentals. Remember unit economics. Gross margins matter, not just revenue. Net income over time will matter. How do you get to profitability on as little money as possible? Be realistic there. Be transparent. Finding an investor is probably harder than a marriage, because you can't just give the money back. So don't just take the first money that comes at you. Really understand who your investor is, what value that person is going to bring to the table, and understand whether that is someone that you can work with for a good amount of time. Because you can't, like I said, you can't just give the money back. So while we're in a hot environment right now and a lot of people are throwing money around. Really understand that once you take someone's money, you're going to be working with that person one way or another. So be picky, be a little picky. So that's all I've got. Last slide is email me, arif@lightspeedvp.com. I'm always open to hearing about new pitches. In your subject line, put in Orrick, so I don't ignore it. But with that, I'd love to open it up to questions. I don't know how much time we have, but Chad will probably cut me off. But any questions? Don't be shy. Yeah.
At what stage, what is the earliest stage within the early startup period that your company can get involved with? In other words, and at how small a level of investment?
So the question is, at what stage does Lightspeed get involved with the company and how early? So there is no hard and fast rule there. We have invested in seeds, and seeds have generally been investments in teams going after ideas in massive markets. Or we've also done Series A's, where it's just an exceptional team that has come together, that has done it before, that understands the market, and has done it for advantage. So there is no hard and fast rule. Yeah.
When does no mean no? You know, sometimes you go to pitch and they say, it's a little early, but come back. When are VCs really saying no?
The question is, when does no mean no? That depends on the VC, unfortunately, and it depends on who you're talking to. I try to be pretty transparent with people in terms of, look, this just is not an area that we're focusing on, or, you're really early. I'd love to get some customer feedback. Can we talk again in 6 to 8 months? So it really depends on the person and that person's approach to things.
So if the VC says come back, let's talk in 6 months, is that usually genuine comment? Or is that
Depends on the person. Yeah. Yeah. Let's see.
How about the patentation and protection of your IP? Is that something you only take in people who have to protect IP?
So the question is, where do patents and IP fit into the way that we evaluate companies? I tend to look at the three things: team, market, product. Patents are a nice byproduct, but they're not something that really makes me lean forward or lean back either way. I want to see some differentiation. In technology, you can come up with new algorithms that potentially could be patented but have not yet been patented. But a lot of the companies that at the early stages of company formation, where it's just an idea, a team going after a market, there may not even be any patents.
How much emphasis should we put on exit strategy in our pitch, or is that something that's need to be discussed?
Yeah. So the question is, how much emphasis should be put on exit strategy? To me, it's a turnoff, frankly. If you're already thinking exit strategy, that means you're focused not on necessarily building a business, but you're building something to flip. I would much rather work with teams who are extremely passionate about building a product to win, and along the way, there will be points, if you're succeeding, there will be points where there will be decisions that have to be made from a mergers and acquisitions perspective or an IPO perspective, right? I would rather that be an ongoing conversation over the journey, as opposed to on day one, look, we think we can flip this to a Google or a Microsoft or a VMware. Yeah, yeah, the question is, in the customer value proposition, there is no reference to financials, and it's implicit in there, in the sense that, let's get to that slide there. I'm stuck on this slide. Here we go. Right, it's implicit in both audience, significance, category, and uniqueness, in the sense that in a great market where you've got a great product, then you could probably charge more. In a crappy category where unit economics are really bad, where gross margins are low, well, then that will really flow into your financials. And so this should absolutely flow into the way that you think about economics. I could say categorically that you will be 100% wrong on your financials, but that's okay. Financials are generally, for us, an indication of how you're thinking about the business, how you're thinking, how large you're thinking, and how you're thinking about unit economics, right? And for us, they're basically a smell test, right? If this guy is trying to build a company that in 7 years gets to 5 million, probably not a fit for me, right? Or if this person is going into a category where gross margins are 2 to 3%, probably very difficult for me to get involved. Versus, you know, a category where 70 to 80% gross margins are normal, maybe you come in with 60 to 50% gross margins, and it's a massive category, and you're thinking about getting to $100 million in revenue over 5 to 6 years. In the back.
What advice would you give to a bright, capable team that has not done it before?
What advice would I give to a bright, capable team that has not done it before? I think it's okay. So teams that we've backed many teams that are first-time entrepreneurial teams, and it really comes down to how you frame what you're building, how you frame who you are, what you've accomplished in your previous lives, and how you have an unfair advantage to win in a very large market. And so if you can get those three ingredients together, that will get an investor pretty excited. So the question is, how flexible are venture capital ownerships? I'd mentioned something between 20 and 40%. Look, it's a negotiation. It really is. I wouldn't focus too much on valuation. I would focus on getting enough capital to get to a meaningful milestone so that you can raise a Series B or, you know, be cash flow positive, and without giving up too much dilution. So it really comes down to a negotiation. But many Sandhill firms for Series A, not for Cs, but for Series As, will put a floor at 20%.
How do you sort of draw that line in your pitch between saying the market is everyone and being focusing too small?
Yeah, so the question is, in your pitch as you're talking through your market, how do you paint a picture that it is a large enough market, but focused? It's an art form. It really is. And you should be honest about it. You should be absolutely honest, because you should be convinced that the market that your product fits into is large enough, because you're going to be investing your blood, sweat, and tears for the next 5 to 8 years.
What form of investment are you doing in Series A? I mean, do you buy stock? Do you have convertible notes?
Yeah.
What usually happens?
So the question is, what does a Series A financing look like from a structure perspective? Series A is typically done as preferred equity. By preferred equity, what that means is that there are rights associated with that equity. Those rights may include a board seat, what is called a liquidation preference, meaning that in the event of an acquisition or an exit, that money comes out first. There are other rights associated with that in terms of investor rights and agreements, but it's generally equity.
You mentioned elevated pitch. I want to ask you about an elevated question. What's the most important question an entrepreneur should ask a venture capitalist?
That's interesting. So the question is, what is the most important question that an entrepreneur should ask a venture capitalist in an elevator? What value do you bring? Yeah.
Are there particular angel groups that you work well with as a kind of source of deals for you?
Sorry, can you repeat it?
Are there particular angel groups that you work well with as a source of deals for you as a deal firm?
So are there particular angel groups that we work well with? We work with many, yeah. I can't name any specifics, but yes. The back.
So you guys are known as team investors. You invest to the team. How often have you found that you have had to go in and kind of restructure the team?
So the question is, how often do we go in and restructure the team? It's a journey. So over an 8-year period, there will be points where perhaps the original CEO can be complemented by someone who's been there, done it before. There may be points where a VP marketing or a VP sales or a VP engineering can be brought in to complement the team. So over the life cycle of a company, There will absolutely be hires, new blood that comes in to help. That's one of the things that we like to help with, to really help scale the organization to the next level. Yeah.
So I know you mentioned that the goal of the first meeting is to the second meeting. Do you prefer not to see how much the company's looking to raise presented in the first meeting?
Yeah, so the question is, the goal of the first meeting is to get to the second meeting, and should they talk about how large the ask is, how much they want to raise? Absolutely, you should talk about it in the first meeting. The second meeting is really there to dive deeper into the product, the technology, the team, the market, the competition. In many cases, the first meeting may be with one partner, and then the partner may bring in a second or third partner into the second meeting to get a second, third set of eyes on the idea, on the team, and then to start talking about a diligence process. Yeah.
Some of your charts have the phrase
One of my slides had founderitis free. What does that mean? Founderitis is a desire to hang on to and control all aspects of a company. It's that person's baby, and they want to control all aspects of sales, of marketing, of product, of running, of leadership, and not necessarily being open to some of the things that can help scale a company, such as bringing in other people into the company or listening to advice in terms of pivoting or potentially zigging and zagging in a large market. Yeah. Yeah, comments on dynamics of how many investors to have in your Series A, 1, 2, 3. It really comes down to the amount you want to raise, as well as the value that you can get out of your venture capitalist. And so there's certain amounts that may be too large a bite size for just one venture capitalist. I'm not going to draw a line where that is, but there's certain areas where you may need, call it 8, 10, 12, $15 million to get to cash flow break even. In that case, you probably want to have a couple of VCs around the table who can contribute not only capital, but also advice, network, value, recruiting, et cetera. And so it really comes down to you in terms of the people that you're talking to and what sort of value you think that they can bring around the table.
I was thinking more about, if you were saying that it should be more involved.
Yeah.
And let's say someone comes to you and you want to go for yourself, or you want to look for investment.
Yeah, so the corollary is, there's situations where the entrepreneur may want a couple of investors involved, but a venture capitalist may want to take the entire round. That comes down to a negotiation, and you have a say in the matter. You can say no. You can push for what you want, what you prefer, and you should. Yeah.
Are there any cap table terms? Can you give me an example on what value you bring to the partnership or your investment other than money?
So what does a venture capitalist bring to the table just beyond money? A lot of it is network. We help, Lightspeed helps with network. There's a lot of introductions that we can make to within the ecosystem of Silicon Valley, outside Silicon Valley, customers. We tend to make a lot of introductions to potential customers, CIOs, VP marketings, VP CTOs at potential customers. We help a lot with recruiting, so scaling the team, bringing in best of class people at the marketing, sales, engineering, potentially CEO down the road level, advice, perspective, pattern recognition. We've seen some of these movies play out before, and so we can help, we can see potential mistakes happen before you may make them, and so we can provide some level of advice. Yeah, in the back.
Are there any cap table turnoffs to doing early funding or going after later seed funding or A's? Are there any things that you would recommend not doing in terms of early capitalization?
Question is, in terms of early capitalization, any pitfalls or things to avoid? Sometimes taking too much money early at too low a valuation can create issues. So if you give away too much of your company early, say 50, 60, 40% early for a very small amount, that can create strange dynamics when we come in with a syndicate and the syndicate potentially wants another 40%. So there may be some work that needs to be done to make sure that the founding team is still very incentivized to go forward.
If you're a team of one, the handicap is that, and how do you?
If you're a team of one, how much of a handicap is that? We strongly prefer to invest in teams of people. Ideally, people with complementary skill sets. Someone from the business side, product, go-to-market, marketing, whatever that might be, and someone from the technology side. So our preference is to invest in teams as opposed to individuals.
How much do you purposefully exclude some investments because you already have a company portfolio that might be considered a competitor?
Yeah. How do we handle competing potential investments? We take it on a case-by-case basis. There have been situations where we invested in things that may have seemed competitors early in a very, very large market, but we had insights into understanding that they were actually not, they were complementary or had some level of overlap, but were not direct competitors. We tend not to invest in companies that do exactly what each other do, though. Yeah.
Get a wide range of opinions on how to value a company, and I know it's a lot of art, a lot of science, but what's your how do you guys do it?
How do venture capitalists value companies? Venture math is fairly easy. It's a matter of how much money is going in and how much of the company we want to own. There really aren't too many spreadsheets that say, well, here's a patent that we're going to assign X value, here's 4 founders that we're going to assign X value, here's a market that we're going to X. There really isn't. It's like that, really tied to X amount of dollars going in, and we want to own this percentage of the company. In the back.
Related to that question about the team, are you looking for 5 guys who quit their day jobs to do this, or could it be a loosely affiliated group that can come on full time?
So the question is, related to team, are we looking for a number of people who have quit their day jobs, or is it more about some people who may or may not have left their companies? You know, every situation is different. We want to see some skin in the game and some really commitment to doing this, and passion can really be demonstrated by saying, look, I love this idea. I've talked to a lot of customers. This market is massive. And because of that, I want to do this. And so we tend to want to see some people lean forward. It doesn't have to be the entire 5 or 6 people. Founders should have demonstrated a lot of passion and enthusiasm about what they're building. That's not to say that we haven't worked with people who have been at companies and during the process left in conjunction with the financing. There aren't hard and fast rules. Is that it? All right. Oh, one more.
Sorry. Following up on the previous question, how do you feel about startups looking for an A round that have a lot of individual investors with a syndicated seed? Such as, you know, if you're looking for $500,000 to get for a seed, and you have 50 people at $10,000 units. There might be less people, of course, but with something like that, how do you have any objections to that?
So the question is, do we have objections to very diverse seed rounds where there might be a large amount of investors? Look, we understand it's hard to raise seed capital, so I'm not going to essentially disqualify a great company because of the number of angel investors. We understand that it takes a lot of work to raise that first initial money and get people on board. So I'm not going to draw any lines in the sand there. Yeah.
Can you walk me through a typical example of a day in your inbox? And how do you go from, you know, you're going to get cold calls by the door, you're going to get more intros than you may, or you're going to get other intros than you look at, you're looking for more kind of feedback. How do you go from inbox to meeting?
Yeah.
And where do people fall off along the way?
How do I triage my inbox, I think is the question. I get a lot of emails. I actually try to go through every single email that I get, and for warm intros, I will absolutely look at the company and see if it's something that fits into our investment profile. For cold emails, I'll scan it, but if it, more often than not, it may be someone who's in in a completely adjacent area, but I will scan it. Yeah.
What's your take on FX stock?
Sorry?
What is your take on FX stock as a venture capital founder stock?
Founder stock. Be a little bit more specific because there's many definitions of that.
Being able to have early exit for the founders.
So the question is, what's my impression of founder stock? Look, I think it's important to have up front. It depends on sort of the rights that are associated with that founder stock relative to everybody else's rights. And so I don't think there's a hard and fast set of definitions around what founder stock is. So it really comes down to what are the rights associated with that relative to what a preferred stock gets and what common stock gets. Yeah.
What about salaries? How do you feel about, potentially very high salaries where there's an agreement that the money gets pooled out, the salary gets paid out of a pool, that budgeted pool, where it's proportionate to what the claimed salary is. Example.
Yeah.
You have somebody for $300,000 and he is willing to be paid the $300,000 out of the $1 million budget for salary, and there's a lot, and it should be $2 million. That would mean you should be willing to accept $150,000 until the pool can get larger.
So the question is about salaries and how to manage salaries in an early stage company. You got to be competitive in the market to get the best people that you can, but at the same time, you as a founding CEO or a founder of the company have to be incredibly persuasive to get people on board, to help them understand that this isn't just about salary, but it's about the equity that you're offering. And so as part of a complete package, you should be offering equity, and you should be selling the value of that equity, because you, of course, are going after a massive market. And this could be a multi-billion-dollar company. And so it's really a matter of painting a vision of there's salary, and then there's exit value that's associated with your equity in a few years. Yeah.
So what about founders' salaries? Well, what do you think of that after raising a seed round?
What do I think of founder salaries? It really is on a case-by-case basis. What is most important to any company is the amount of cash and runway that you have at a given burn. So that's up to the founders to determine, we've raised X money, where do we want to put that money? Do we want to take a step back from our personal salaries because we own X amount of the company and go hire 1 or 2 or 3 more people? Or do we want to take that seed capital or Series A capital and pay ourselves? But that may mean that we have to do more with fewer people because we can bring in others. That's your call. So if that's it, thank you so much. Really enjoyed it. Come find me afterwards.